Hey guys, it's Nick. The employment report came out on Friday and it was much better than expected at 528,000 jobs added, blowing away the expectations of only 250,000 jobs. What does this mean for interest rate increases and the stock market? Well, on Wall Street, they are hoping for data that shows a weakening economy in the hopes that the Fed stops raising interest rates and starts lowering them next year to give a boost to the stock market. Never mind that a recession means hundreds of thousands or millions of people will lose their jobs and have financial difficulties. Right now on Wall Street, bad news is good news. We have now had 2 quarters of negative GDP growth, which means we are already in a recession. But then why are we still adding a lot of jobs every month? Shouldn't we be losing jobs if we are in a recession? Well, for one, the labor market lags recessions because it takes a while for companies to go from seeing sales and demand drop to actually cutting staff. The other reason is that maybe these numbers are not that accurate and will be subject to future downward revisions, which is not uncommon. There's actually a big discrepancy in the two surveys that the Bureau of Labor Statistics does. So let's take a look and see what's going on with that right now. So here, Zero Hedge says something snaps in the job market with multiple job holders hit all-time highs as an unexplained 1.8 million jobs gap emerges. This jump in non-farm payrolls to 528,000 is a pretty big jump over the previous 4 months. And actually, wages were also hotter than expected, rising 0.5% month over month or 5.2% year over year, which caused many to conclude that calls of a recession are premature because, after all, you can't enter a recession when jobs are rising by over 500,000 a month. That's true, but it doesn't coincide with this third-party data, which tracks the number of new employees laid off as well as new layoff events, both of which have soared since May. So there hasn't been this many new employees laid off and new layoff events since around the pandemic shutdown in 2020. Now, there's actually two surveys, the household survey and the non-farm payroll survey, or the establishment survey, where they actually talk to businesses and governments, whereas the households, they call about 60,000 households and survey them. And last month, there was a discrepancy in the household survey as well, showing that there were 300,000 or so lost jobs. And this month for July, they're showing a gain of 179,000 new jobs versus the establishment survey, which says 528,000 new jobs. And even with this surge in jobs, the labor force participation rate is down for the second month in a row and is back to levels last seen in 2021. So the jobs are supposedly going up, but the labor force participation is going down on a percentage basis, down to about 62.1%. So here's where something is not right. You see, the establishment survey and the household survey pretty much track neck and neck, but starting in March, that stopped. And now the household survey comes in consistently a lot lower than the establishment survey, to the point where there is a 1.8 million jobs differential between the two surveys. So depending on which survey you go on by the BLS, if you ask how many jobs were created since March 2022, they'll say, well, 1,680,000 based on the establishment survey. But the household survey says, no, we lost a total of 168,000 jobs since March 2022. And so the household survey says that they lost 141,000 full-time jobs and 78,000 part-time jobs from March to July. So how is that possible? Because of supposedly multiple job holders or people who have more than one full-time job. So the level of multiple job holders is back to the level of March 2020. So although there were losses in full-time and part-time jobs, multiple job holders increased by 263,000 from March to July. So, multiple job holders whose primary and secondary job is full time is now at a record high. So, are the record multiple full time job holders an indication of a strong economy or a weak economy? One theory is that people need to have two full time jobs to help pay for the increased costs of everything with the inflation that we're having. Another theory is that with so many people working from home full time, it is not hard or impossible for somebody to take on two full time jobs from their work from home job without either of the other employer knowing about it. Maybe double dipping during the same 8-10 hour work period and getting paid for two full time jobs. Either way, what does this mean for interest rates and the stock market and the Fed and all of that? Let's take a look. So the huge job gains has removed any hopes of a Fed pivot, of them going from raising interest rates to lowering interest rates anytime soon. Matter of fact, rate hike expectations are now soaring, and now they are expected to reach 3.5. And the odds of a 75 basis point hike in September are now over 70% once again. And JP Morgan says 75 basis point hike in September now looks likely, while Goldman is still saying 50 basis points. And here's a chart of the interest rate hikes of Goldman Sachs's forecast versus the market pricing today. And so Goldman Sachs is saying 50 basis points in September, 25 in November, 25 in December, while the market is priced today saying 59 basis points in September, 29 in November, and 10 in December. With the end of 2022 forecast of Goldman Sachs saying 3.25 to 3.5%, and the market pricing is 3.31% by the end of 2022. So very similar. And one thing to look at here is the inverted yield curve, which is the difference between the yield on the 10-year note and the 2-year note. Normally, the 10-year note interest rate is higher than the 2-year note. And when they switch and invert, and we have an inverted yield curve like we have now, that is an indication that we are heading into a recession. And you see, it has predicted the last 4 recessions in the last 40 or so years. So this is the zero line. So anytime that it goes below the zero line, that is a inverted yield curve. And so we had it here and then had this recession, this pink line here. We had it here, had the recession not far after, same in 2008, 2009. The yield curve started inverting around 2006. And so it happens sometimes a little bit in advance of when the recession actually hits. And what happens is it inverts and people say, oh, it's different this time. This is not really an indication. And then it bounces back up and they go, oh, see, everything's good. It's back above zero. And then you have the recession. Same like here. The recession doesn't hit until the yield curve is really back above. Same here. And so we are now further below zero than we were in the 2007, 2008, 2009 financial crisis. We're at the levels of the internet bubble inversion. It was kind of a surprise on Friday that the stock market did not react too bad to the good unemployment report. The CPI report next week should confirm if the Fed will continue hiking with a 75 basis point increase in September, or if a lower CPI will give them some cover to say that inflation is coming down so we can put off interest rate hikes or at least do smaller ones while we reevaluate. Personally, I think the market is still in the hope phase, hoping that interest rate increases are over, and next year it will be back to lowering rates to combat a recessionary economy. One thing to remember, anytime we have had the CPI go over 5%, the Fed had to raise interest rates above that CPI level to stop inflation. Keep that in mind if you think this rally will take us back to the levels close to the previous highs. We will either have to have a severe downturn to kill demand, which lowers inflation, or Inflation continues higher until the Fed raises rates more aggressively, which will also slow the economy and reduce the inflation rate. The stock market is forward looking, but I don't think it's already looking past those scenarios. There will have to be a readjustment in people's expectations. And so the bottom may not come until people have no interest in watching YouTube videos about the latest economic data point and how it will affect your stocks. We're not there yet.